Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Burgo. You're welcome to Bloomberg Brief. Let's set your agenda.
It's 50 versus 25. The great rate debate rages on after reports of the Fed's dilemma. No deal. Boeing factory workers walk off the job for the first time in 16 years, rejecting the deal on the table. The next step in AI, human reasoning. A new release from OpenAI pushes the capabilities to a new level. Good morning, Manus.
Danny, good morning. Let's test the boundaries of OpenAI a little bit later in the show. What we're testing this morning is the Journal, the FT, and of course, Mr. Dudley, all infusing an extra drop in the yield, down by 12 basis points from the high yesterday to this morning. This is on the short end of the curve. As you can see, yields lower again by 6 basis points. Why? Because suddenly 50 basis points is back in the narrative, back in the betting market. 33% possibility that you will get a 50 basis point cut next week. Is this just flying the kites on behalf of the Fed? To equity markets, again, it's as if we've shifted from buy the dip. We're incrementally moving towards FOMO. Oracle is up this morning, nice guidance for them next year and through to 2029. Significant move lower, as I said, in the yields. The consequence of that is the dollar is on the back foot. The yen is up for the fourth day, counting down to the BOJ next week. Danny, good morning.
Good morning, Manus. How serious is this chatter of moving 50 basis points? Nick Timiraos was the thing that moved yields from gaining on the day to losing, writing the Fed's rate cut dilemma. Start big or small, and then you get this from the FT. The Federal Reserve faces a close call on whether to cut by a larger or a quarter point percentage for a cut. It might be just because we have those memories of June 2022 in our minds, where Nick Timiraos put out a story that shifted the market's thinking from 50 to a 75 basis point hike, and that's indeed what we got, 75 basis points. Or is this just setting us up for a dovish 25 basis point? I mean, what really in this market, what we've heard from Fed speakers, there's been nothing there to suggest that they're ready to go at 50, maybe except for Powell himself.
Well, maybe this is the juxtaposition between what the market is pushing for and perhaps what the Fed wants to deliver.
Totally.
And perhaps it's trying to bring that narrative together at 25 basis points, but with a nice dovish tilt. Bill Dudley, of course, ex-New York Fed governor. I think there's a strong case for 50 basis points, and I know what I would be pushing for. So this is about the concertina between Powell and the rest of them, and trying to bring that closer together.
Well, you could see a scenario where you have this discussion after the FOMC decision and what you get in the dots, and it makes it clear that maybe even if they don't go 25, they want 50 at some point. Maybe they still match market expectations of 100 basis points. And maybe that's what's more important from what we get and why we're seeing some of this kite flying of a jumbo rate cut.
Well, it's certainly that. I mean, you've got all of that. Does it embolden somebody like Waller to join in with Powell? And you know what? There's a lovely line from Neil Dutta at Renaissance, which is, go in size when you've got the time and the scope and you've got the space to do it, rather than when you are forced to do it.
Yeah, a lot of people argue that. Maybe it's just, stasis from the Fed and what they usually do and the inability to break from that. Let's get over to Athanasios Vamvakidis, global head of G10 FX strategy at Bank of America Global Research, who joins us now. Thanos, great to see you this morning. So is this really a live decision? Do you think it's likely the Fed doesn't know at this point whether they're going 25 or 50?
Based on the data and the fundamentals, they should go by 25. But the truth is that all the speakers have not really closed the door to 50. So at this point, is a close call. What I would say, if they go with 50, it will not be as if the Fed knows something we don't know. It will mostly be a preemptive jumbo cut to avoid a risk of a hard landing down the road. However, preemptive aggressive cuts could lead to a shallow easing cycle. So the big scheme of things is how far the Fed can go.
Thanos, good morning. Maybe
Good morning.
next week, and we've got to see where we end up. What do you make of this proposition that this is the market pushing and pushing for, if they get 25 basis points, but to get a more explicit narrative on the destination? They didn't get it from Christine Lagarde, so maybe this is pushing to get clearer dovish guidance from Powell.
I mean, a lot will also depend on retail sales that we get before the Fed meeting. But no matter what the Fed does in terms of 25 or 50 bips next week, I think the guidance will be dovish. Powell will be able to do what Lagarde was not able to do yesterday, to announce a proper easing cycle, while Lagarde is just removing restrictiveness. That's a paradox in a way, because the US data is better than the Eurozone data, but the truth is that the US economy is in a soft landing, is slowing. The Eurozone economy, on the other hand, is stuck with sticky core inflation, and unemployment, at least, is increasing in the US, is not increasing in the Eurozone.
I mean, what do you make of that? The fact that there has been this dollar weakness, that's the bias for this market. And I understand what you're saying, Thanos, that you still have the stickiness of inflation in Europe, but it is a much stronger US than not just Europe, but economies like China, too.
The truth is that the US dollar is overvalued, and if we're in a world of a soft landing in the US with the Fed cutting rates, this is still positive for risk and negative for the dollar. We are in the middle of the dollar smile. Now, the dollar would weaken even more if we were to see faster growth in Europe and in China, which is the ideal scenario in the middle of the dollar smile. That's not what is happening. So it's driven primarily from the US soft landing and the dovish Fed, but this is still enough to lead to a gradual weakness of the dollar from a long position, which is exactly what we have been seeing.
So, Thanos, are you saying that the dollar's exceptionalism, US exceptionalism, is now really challenged?
Up to an extent, yes. We can argue that the US exceptionalism was also driven by very loose fiscal policy. The US economy will continue performing better than the Eurozone economy, but is slowing. This is a big deal, and the dollar is overvalued. So there is room for the dollar to weaken. Our forecast for euro dollar by the end of the year is 112, which is not very aggressive, actually. We're at 111 right now.
So I take it you disagree with Morgan Stanley then, Thanos, who says that there is a risk of near parity, about 102 euro versus dollar. What do you make of that call? It's predicated on the fact that the market's underestimating just how much the ECB may cut.
We completely disagree with this call. Our view is that the ECB will be cautious. The Fed is starting most aggressively. In both, inflation is sticky, but the US is slowing, and the euro-dollar long-term equilibrium is 120. In the past, you went close to parity only when there was a severe shock, and that's not what we have today.
So you're taking some quite contrarian positions here. So let's extend that with Darren Maher from HSBC with us yesterday going, I don't understand why it's at 110 at the moment. 10 weeks of soft data. Germany's under pressure. Perhaps they should be talking more about jumbo cuts in Europe than in the US.
The mandate is different. The truth is that core inflation in the Eurozone is stuck at 2.9, 2.8%. Services inflation has increased. Unemployment is not falling. And actually, Eurozone growth is not really slowing compared to last year. Germany is weakening, but the rest of the Eurozone has stabilized at a low growth equilibrium. So in relative terms, it is hard to justify a weaker euro at this point, despite the weaker data. Weak data in the Eurozone is not new news. It has been happening actually since the global financial crisis and has to do with structural reasons.
While we're talking about contrarian position, Thanos, you are bearish on the yen. The yen, though, at this moment, dollar yen at 140, about its lowest since July of 2023. Why would you push back on that?
Well, up to an extent, we can argue that yen has moved quite a lot, and if the Fed cuts by less than market pricing, you can see some renewed yen strength. Having said that, I think we have shifted to a regime in which if we do get a new dollar-yen rally, we will sell it. And in any case, we don't expect dollar-yen to weaken by much because we don't expect the Fed to go that far cutting, and also we have structural outflows from Japan. So it's not that we are bullish dollar-yen, we are just not as bearish as the consensus.
Okay, well, that yen has moved by 14%, strengthened by 14% since the end of June. Great conversation, Thanos, as this market revs up again on the risk of a 50 basis point cut from the Fed. Athanasios Vamvakidis of Bank of America Research. There are other stories trending on your Bloomberg terminal this Friday. This is what we've got for you. Hedge fund Millennium Management is looking to raise between $7 to $10 billion of new capital. It will do so by asking the clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to lock up its client cash for longer.
Berkshire Hathaway's vice chair of insurance operations, Ajit Jain, sold $139 million worth of his Class A shares in Warren Buffett's conglomerate. The sale of 200 of his Class A shares marks a shift for him after adding to his holdings in the year up to March. He is one of Buffett's top lieutenants.
Hindenburg Research is taking another swing at the Adani Group. The short seller is said in a post on X that the Swiss authorities had frozen more than $310 million. This was part of a years-long probe into the Indian conglomerate for money laundering. The Adani Group denied and called it baseless allegations.
Coming up, Boeing's largest union says to a labor deal. They say no, setting up for a strike for the first time in 16 years.
And later this hour, we speak to BlackRock's Amanda Lynam on why she believes the drivers and depth of the rate cuts are more important than the timing. Context matters on Bloomberg.
We just announced over in the Stewards Hall that our members rejected the contract by 94.6%, and they voted to strike by 96%. There's a lot at stake here for our members, and so I am proud of them. And we're going to, get back to the table as quickly as we can. I'm not sure what that looks like this evening, but we'll certainly engage so that we can try to resolve the issues and address what the members' needs are.
John Holden, the president of Boeing's largest union, and the workers have walked off the job for the first time in 16 years. This is after rejecting a labor deal. This strike involves 33,000 workers. It further cripples this plane maker's manufacturing process, the Seattle commercial jet hub. Guy Johnson is no stranger to the airline story. The stock's down 3.85%, 33 workers going out. And if they go out for their typical time, how wide is this gap between management and the workers, Guy?
Manus, Stephanie Pope, who runs the commercial operations at Boeing, says that they've left nothing on the table, but clearly they are going to have to find something and put it on the table because Boeing can ill afford this to go on for very long. 2008 was the last strike. That lasted circa 50 days. The longest one was back in 1948, and that lasted 140 days. There's some talk, Manus, that this could go to federal mediation. That would probably mean that this process is a long one. There's some talk that this could last until Thanksgiving, and if it lasts until Thanksgiving, it could last into the new year. So Boeing is going to have to find some more money. This appears to be about money. The 25% that has been offered appears not to be enough for the vast majority of workers. The removal of the bonus has gone down very, very badly. Boeing, with its new CEO, is going to want to get back around the table. How much more money can Boeing find is the key question.
And Kelly Ortberg, the new CEO, had just said before this, essentially, don't go on strike. We're in a vulnerable time. What will be the impact, Guy, to Boeing's operations if this continues to drag on?
Boeing gets paid, Danny, when it delivers aeroplanes. It will not be able to deliver aeroplanes. As you say, it's got a multitude of other challenges that it is facing right now. It needs to deal with those. It's had massive problems with the 737 program, the MAX program. It's having big problems with the 87 program. It's got problems with the 777 program. It needs to get back on track. This comes at a very, very bad time. I guess that probably is why machinists view the power they maybe have and are making this decision. But they're going to want to get this done very, very quickly. Boeing gets paid when it delivers aeroplanes. This is going to make that very, very hard. It's going to have a meaningful impact on cash flow, and that is why the stock is down this morning. The expectation at the beginning of the week that this deal was going to go through. The deal had been done with the union. It's been clear over the last few days that the bulk of the machinists were going to vote against it. The market's been getting ready for it, but the fact that this has now happened is being reflected in the share price that is once again softening this morning.
Yeah, the strong hand of the machinist. Guy, thank you so much. That's Bloomberg Opening Trade co-anchor Guy Johnson. Let's move on to tech now. OpenAI is releasing a new model capable of performing some human-like reasoning tasks. It's known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated math and coding questions. Joining us now on this story is Bloomberg's Tom McKenzie. Tom, just how big of a step forward is this?
Well, OpenAI say this is a major evolution in terms of the process and the development and the innovations around artificial intelligence. And there are experts out there who say there are also potentially some benefits in terms of the safety and reducing risks around some of these technologies. But this is early stages in terms of where we are. This is not about generating answers by scouring the web and data that's been fed into these models. This is about reasoning, as you said, and it can be a multi-stage process. These models are trained using reinforcement learning, so they're essentially rewarded when they make positive moves and they get these steps correct. They are given a reward, and that's how you build these models. And so they're very effective, it seems, in terms of the first iterations, and we're just getting our hands on them, in fact, as of yesterday, to do things like coding and very, very complicated maths questions. These are not multimodal models, so they can't deal in audio or visual like, for example, ChatGPT-4 can. But this is a major step, OpenAI says, in terms of this reasoning capability. Anthropic, Google, also working along models along these lines. So we should see further progress you would expect in the weeks and months ahead. And of course, it's pretty important it comes out of the week when OpenAI, on some measures, was valued at about 150 billion US dollars.
Yeah, well, just think of the additional power that is going to be needed here. A ChatGPT inquiry takes 10 times your average search. So if you just think for AI reasoning, just multiply that up. Look, Oracle's had a pretty blistering week. All-time high at the start of the week. That was on some of their web businesses. But again, they've given really, really strong guidance about next year and a little bit further out. It's very solid and assured guidance, isn't it?
It is, and look, you're absolutely right to tie it to the fortunes of OpenAI to some extent as well, because it's the cloud database software that Oracle produces that has proven very effective at dealing with these heavy generative AI workloads, and that's what their customers are happy about, and that's why you can continue to get these sales coming through for Oracle. And you're also right, look, this is a company that's been nodding at this kind of performance and nodding at these results, nodding at this demand. There was an expectation from analysts that they would upgrade their 2026 fiscal year forecast. What wasn't expected is that you'd also get that guidance pushed out on the upside for 2029. So they now see revenues rising to at least 104 billion US dollars in fiscal 2029. They upgraded again the 2026 targets to 66 billion US dollars. Look, some of their customers include xAI, Elon Musk's xAI, Reka as well. The analysts coming out and saying, look, the clear response is, the details are in terms of the upgrade for 2029, it really suggests that Oracle sees these tailwinds around Gen AI continuing in the years ahead for their software.
Yeah, well, certainly OpenAI back in that market. It's timely on their piece as well in terms of what they can do. Helps you on that roadshow to raise money. Tom, thank you very much. Bloomberg Daybreak Europe anchor Tom McKenzie. Coming up in the show with Danny and myself, we'll take a look through the headlines that are making news around the world, including a report that Trump allies want to privatize Fannie and Freddie. Context matters on Bloomberg.
It's your Bloomberg Brief. On this Friday, I'm Danny Berger alongside Manish Cranny in New York. Let's get you some front page news. What's making headlines around the world? First up on the Bloomberg, Danish freight firm DSV is buying its German rival for 14.3 billion euros. They beat the PE firm CVC Capital in a race to acquire the company. The deal makes DSV one of the world's largest logistic companies.
Next up, the FT. Pink Floyd are in talks with Sony over the music rights sale. Now, the talks have been advancing after personal differences among members of the band. Strange that in rock and roll, about reaching an agreement, a little bit more difficult. Can you imagine that? Catalogue valued at $500 million. Rockers on the road deciding how much their music is worth.
That's a hot asset. Everyone wants to buy music rights. Okay, so this from the Journal this morning, Manis. Trump allies are working on a plan to privatize Fannie and Freddie Mae. Discussions have been underway since at least spring. One thing is clear is there's some people who stand to gain from this. Both Bill Ackman and John Paulson are holders in Fannie and Freddie Mae. They both support Trump, and they both have been calling for privatization of them.
Yeah, look, this goes back a long way. Of course, Fannie and Freddie don't issue mortgages. Everybody knows that. But it's the 2019, it was the Trump administration. They floated the idea about releasing the grip. And guess who's in charge then?
Well, okay, this
Treasury Secretary Steve Mnuchin. So,
yes.
You know, he's got a bit of form in these things.
They gave up on it essentially because one, Trump lost the election, and then 2, COVID was happening, and there was this sense that the housing market was so fragile that messing with these behemoths would be an issue. I mean, you could make the same argument at this moment, Manus, that housing is quite particularly in a vulnerable spot as we start to debate rate cuts, considering the unaffordability of housing. Is it an issue if you start to tinker with these? But there's always a difference between what kites are floated during a campaign and what actually is a policy that the administration wants to pursue.
Well, I can tell you, as the dominoes fell over that period of time, you know, between Lehman, Fannie and Freddie and a host of other institutions, it's the kind of systemic part that it is in this housing market in the United States of America. There's only one story that's rocking and rolling. It's 50 basis points are back on the cards again. Have a look at the 2-year notes over 4 days and you begin to understand risk on, risk off. 25, 50. There you go. What have we got? Down 12 basis points from yesterday?
Yeah, you pointed this out to me, how big of a swing, down 12 basis points from the high of yesterday. I think we can have a robust debate coming up on just how much that journal story actually matters. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
It's 50 versus 25. The great debate rages on after reports of the Fed's dilemma. No deal. Boeing factory workers walk off the job for the first time in 16 years, rejecting the deal on the table. The next step in AI, human reasoning. A new release from OpenAI pushes the capabilities to new levels. Danny, good morning. Can't wait for that.
Can't wait for that. Maybe you won't see me standing in front of here doing a market check. Maybe it'll just be OpenAI reasoning in a human level to do this. Anyway, Manus, the thing that we need to reason around right now is a story from both the Journal and the FT saying that the Fed is trying to decide between 25 or 50. That was enough to both reinvigorate the equity market. Equity during the cash trade moved higher. S&P futures higher yet again by 0.2%. It also reversed what we were seeing in yields. 2-year yields go back to around their lows in 2 years after moving higher yesterday. That swing from yesterday's high to today's low, about 12 basis points, 3.5%. And the dollar versus the yen, that weakens by nearly 1%. We are at 140, the weakest level since summer of 2023. And Manus, all of this, again, appears to be off the back of a story from Nick Timiraos, basically titled "The Fed's Dilemma: Go Big or Go Small."
Yeah, I mean, I've had some pretty scathing IBs in terms of this particular article. And I think what it does do, if anything, it brings back for the Fed the optionality, which had been taken off the table. If you look at the 2-year notes over the past 5 days, that optionality had been taken over the table. You and I sat down with HSBC. We sat down with Allianz. HSBC said, get this snowplow out of the way. They don't need to do 25 basis points is what Allianz said. But maybe the Fed will welcome this optionality, the fact that 33% possibility of a 50 basis point cut. It means it can be not such a shock if it comes down the pike. But it's still the skew is it's unlikely.
Right. Well, it just feels like the first Fed decision in a while, and these stories really enforce this, that we just kind of don't know what they're going to do. Maybe it just allows them to have more FOMC members to say we wanted 50 basis points and set themselves up to go at it later. It's a really confusing one. I was kind of joking in the break. What if Nick Timiraos was simply trying to write just like a big thought piece, and now we're left just trying to read the tea leaves of something that maybe isn't exactly there?
But I think that just shows you how febrile the whole situation has become. You've got Powell, we know a little bit more, dovish at Jackson Hole, we've got Waller open to doing bigger cuts. This just shows you just how fine a line we are on. Amanda Lynam is our guest this morning. She's the head of macro credit over at BlackRock. Now, you're going to have a much smarter answer than the both of us. But this whole narrative that the kite is flying again on 50 basis points, our guests have said, tuck it away. What do you think of the Journal article? What do you think of the risk of 50 basis points, the risk and necessity?
Yes. Well, good morning. Thank you for having me. I don't think we can rule out a 50 basis point cut. I think the important thing that we've emphasized, though, is that the depth and the drivers of this rate cutting cycle really matter for corporate credit sentiment and I think risk assets more broadly. If there is a start to the cycle that begins with a 50 basis point rate cut, I think the messaging needs to be very crisp around where the neutral rate is, why we are starting with a non-traditional magnitude of cuts, because absent that sort of clear messaging that we are doing this to get back to a neutral territory, I think the market could interpret that to mean that they are responding to some sort of growth downside. So I think the messaging around the drivers is really important. And then more broadly, leaving kind of this year's rate cuts aside, we believe that there's scope for the Fed to cut to the, say, call it 3.25%, 3.5% range next year. And then we need to start having more clear conversations around where is neutral, where is the destination. It's not to say that they couldn't cut beyond that level, but I think once we start to get in that zip code, I think it becomes a more finely balanced decision as to are we normalizing or are we actually easing?
Well, because the oddity of it, of cutting something more than 200 basis points within the span of a year is usually something you'd see in a recession.
Yes.
But as you're talking about, it could just be getting us back down to neutral. Do you trust in the Fed's ability to communicate that, if that's actually what they want to do?
I think they will have to. They've been communicating to us that the neutral rate is moving higher by function of the longer run Fed funds rate. So it went from 2.5 to 2.6, 2.8. We'll be watching the SEP in the September meeting to see if it moves further from that. Fed officials have also said that short-term neutral could even be above that 2.8% long run dot. So I think the directional trend they've been messaging. But for corporate credit, what that really means is that we are unlikely to revisit the depths of the zero lower bound of rates that prevailed for much of the past 15 years. And I think we need to adapt to that.
Can we just talk about the structure and the flow into credit? Yesterday, Mohamed El-Erian was with the team and he said, look, money from the sidelines is coming into bonds. It's like the last sale of a decent yield in bonds. What are you seeing in terms of that flow into credit?
In addition to the money from the sidelines that's coming out, and I would say even asset class rotations, keep in mind that we are in a higher coupon environment, and all day, every day, bonds are throwing off higher coupons that need to be reinvested in the market. So the technical picture is really strong, not just from the demand side, which you mentioned, Manus, but there hasn't been a lot of new supply that isn't related to refinancing risk, specifically in the high yield and leveraged loan markets. And so we have a very favorable technical setup in corporate credit. It's a very growth sensitive asset class, though, as you know. So there is a lot of scope for spreads to widen if we have a severe growth downturn, not even a recessionary downturn, but just a really sharp slowing, not our base case. But actually, it's been hard for the credit markets to sell off in a sustained way. You've seen the markets try to widen. Money comes in, especially yield-based demand. So there is this tug of war between, I would say, tight spreads, as we've discussed before, but actually still pretty attractive all-in yields, and we think it's a pretty compelling opportunity.
Well, to the point of higher coupons, this is from JP Morgan. The high-grade issuers are going to pay $420 billion in coupons this year. That's up almost 20% from last year. And this idea that even if rate cuts are coming, higher costs stick around for some time because there's a lag there. So what does it mean for these corporates to have an environment where bond expenses aren't falling as fast as potentially margins are?
It's right. I'm less concerned about the investment grade cohort of the universe because they just have so much financial flexibility and a cushion. But your point is well taken, is that we had ultra low rate environment in 2020, 2021. A lot of debt was put on the books. That's rolling off. It's getting refinanced at a higher cost. I will tell you, though, corporates have shown an ability to navigate that. Actually, EBITDA and earnings, for the most part, have held up pretty well in a higher cost of capital environment. We've already seen some damage as well in the default rate. So I would say that actually the weakest among the corporate credit investors have been responding to this higher cost of capital. Leveraged loan defaults have outpaced high yield bond defaults by the most since the Moody's data began in 1995. And so we're seeing it come through.
We started the year talking about the risk of a 2025 refinancing wall.
Yes.
From the action that you've seen, has that been much, much reduced? And that's much less of a risk and therefore contains the credit spreads into 2025, even on a slow down.
That's right. The catalyst for spread widening is unlikely to be a payment shock in our view, right? It's more likely to be a growth downturn. Corporates have been so proactive, Manus, that they are now chipping away at 2026 and 2027 maturities, right? So high yield corporates typically don't let their bonds become current or due within 12 months. So we should always be expecting that very near-term maturity walls are low. That's just prudent risk management. But it's gone even beyond that. They've extended way beyond that 12 months, and they're actually refinancing a few years in advance. I think that's prudent, given some of the headline risk later this year, potential for a growth slowdown, although not our base case. Always good to refinance when you can, not when you have to. And I think the volatility from early August showed us that things can change very quickly.
Right. But as we've been talking about, a lot of the action in the corporate bond market has been refinancing. There's been less so about deal activity and funding deal activity. As we start this cutting cycle and we kind of reflect back on where we've been, is there any element where, because companies have been unable to make those kinds of actions, that they've been able to do less things that allow for expenses maybe to come in, more efficiency? Is that the just trajectory of growth is going to be slower?
Yeah, so for sure on the sponsor-related M&A side, volumes have been pretty muted still. So those are deals that are involving some sort of private equity or leverage transaction. Strategic M&A, however, is actually running well above the pace of the past 2 years, and it's not that far below the 10-year average. I think part of that is that the COVID pandemic shined a light in a lot of CEOs and boardrooms' minds that there are gaps in business models that need to be filled through inorganic activity, so diversifying your business through acquisition. The swift rate hiking environment put a pause on that. Now that we have more clarity on the environment, optimism around avoiding a recession, CEO confidence, actually that activity has started to come back across a range of sectors. It's not obvious to me that corporates are really hunkering down and preventing themselves from moving forward with the strategic actions that they need to take. I actually think if we can actually get the rates cut cycle going a bit, get some clarity on neutral, I think it would be a really strong tailwind.
One thing that came through from Allianz yesterday was that everything sort of comes to this kind of crunch stop over this election. Either the Fed is crunched into a stop, or the world crunches into a little bit of a crisis in terms of a challenged election. What are the reverberations? What are you seeing in terms of preparation for that, if at all, or the consequence of a challenge around the election?
It's really all about the policies from our perspective. I think having prudent diversification and nimbleness in portfolios is really what it's going to come down to. I think it's very difficult to call in advance because there are so many different paths that policy could take. But really what we're watching are what does this mean for trade, for tariffs, taxes? Those are really the key impacts for corporate credit investors.
Amanda, always brilliant. We really love having you on. Thanks for joining us. Amanda Lynam of BlackRock. Enjoy the rest of your Friday and your weekend. This is Bloomberg.
We just announced over in the Stewards Hall that our members rejected the contract by 94.6%, and they voted to strike by 96%. There's a lot at stake here for our members, and so I am proud of them. And we're going to, get back to the table as quickly as we can. I'm not sure what that looks like this evening, but we'll certainly engage so that we can try to resolve the issues and address what the members' needs are.
That was John Holden, president of Boeing's largest union. Boeing workers are going on strike. It is the first time they've walked off the job in 16 years. It involves 33,000 workers, and it further cripples production at the Seattle commercial jet hub. Joining us now in person is Benedict Campbell. Benny, great to see you. I know you've just been out and about in D.C. talking to a lot of the industry. What is the wider implication of having a strike at a time where Boeing is trying to get back off the ground, and they are trying to fix a lot of problems?
Well, you said it. Really, this is a company in trouble already, and this is the last thing they needed is one more thing that they need to work with. And we heard here from Holden saying, let's see how we can get out of this. He said himself, I don't quite know how it'll go. But if you listen to his words, he seems to sort of extend an olive branch and say, we think we can get this resolved. It's unclear what exactly the metrics will be. Will it be pay? Will it be more on pension or on bonuses? They did get the guarantee that the next aircraft would be produced in the US or in the Seattle area. So that's good for workers. But really, they felt shortchanged on this one. So it's really going to be about the money, which Boeing doesn't have.
Look, you say the workers felt stiff. There's gaps here. There's gaps between the workers, the union leaders, and management. If I look at what Stephanie Pope had to say, she said, we put our best foot forward. So where are they going to get the extra money to close these gaps? Because they're already under a lot of pressure.
That part is unclear because, Boeing really doesn't have the money right now. They're bleeding more than $1 billion each month, and that's not going to get any better. The production is going to be disrupted, and that will in turn cause more financial strain on them. There are estimates out there that a prolonged strike might cost as much as $3 billion in cash flow. And this is a company that has a credit rating that's close to junk, and that's something that investors are watching very, very carefully. They have $45 billion in debt, so they need to protect that credit rating. So very little wiggle room for them, but ultimately, putting a little bit more money into the pot is better for them than a protracted strike. So that's really sort of the balance they need to strike.
I mean, what a way for Ortberg to start the run as CEO. In what way will this reflect him, Ortberg, Kelly Ortberg, as CEO, and how he moves forward in managing this company?
You're absolutely right. I mean, he's really been thrown into the deep end here. He put out a message a couple of days ago saying he urges everyone to leave past fights behind, move forward, see the light, as it were. But there was sort of a bit of a veiled threat in that message, and that's at least the way it was read by workers. Is like, if you do this, there's nothing good to come out of the strike, and maybe that will have sort of energized people. You saw the numbers, more than 90% on both counts. He's stayed a little bit in the background for now, so what this might give him is a way to come forward and really take the helm of the negotiations. Those have been led by Stephanie Pope, as you said, Manus. So Ortberg can come into this now, and if he can turn it around, then maybe if it's a short strike, he'll be seen as somebody who made peace with workers, and that'll go a long way.
Well, that carries a lot of favor in many of these organizations. You're on the road. This kind of disruption, additional disruption at Boeing, I'm not saying it's necessarily an opportunity for Airbus, but it certainly must bolster the narrative for them relative to Boeing again.
Yeah, again, exactly. And this is something we've seen since the start of the year, and probably even before then. You know, Boeing's been in several years of crisis.
Yes.
Airbus has said, look, we take no pleasure in our rivals' misfortunes. Something going wrong at one manufacturer is bad for everyone, particularly something that's safety related. And the truth is, Airbus have issues of their own. They're not as pronounced as Boeing's, but they can't just sort of jump in and say, anyone want to buy a couple more planes? Because they can't produce them at that speed. This is a very long-term industry. Contracts are long-term. Relationships are long-term. So you don't just sort of switch from one manufacturer to the other. But the optics are that, you know, this is one company that's down, one that's up. You're slowly seeing a diverging path in terms of the market share. It used to be pretty much 50-50 on the narrow-body aircraft. Now it's more 60-40, probably moving more towards 70-30. So that's all happening.
But this all comes down to the reliability of the partner that you have in the supply chain that they're dependent upon. Benny, thank you. Good to have you here in New York. Safe trip back to Germany. Benedict Kamel there on the very latest from Boeing. OpenAI, they are releasing a new AI capable of performing some human-like reasoning tasks known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated math and coding questions. Two of my favorite subjects in the whole world. Tom, you're right. Tom McKenzie is with us. So Strawberry is the name of the game. Math and coding. Well, coding wasn't around when I was a lad. So Tom, talk us through the next iteration of OpenAI.
Yeah, Manus, I was just imagining this is your weekend set up, isn't it? The coding and the maths problems. And now you'll have a hand in that effort, in those weekend joys, Manus Cranny. Yes, so they've come out with this new model that is focused. They say, look, this is going to provide a new AI capability. Their competitors, Anthropic and Google, have been working on this as well. They have similar capabilities that are coming to market. But it is seen, at least by the team at OpenAI, as a pivotal moment in terms of the ability of this technology to perform tasks that even GPT-4, their most sophisticated and largest model, still cannot perform. So that is crunching and coming up with answers for some of those most complicated questions and riddles, whether it's science questions, maths questions, or indeed, and some of the demos have showed this, actually doing coding and building things like games in a matter of minutes. Here's the challenge, though, around this new platform, this new model that they've pushed out. Number one, latency. Basically, it takes a long time for them to answer, the model to answer, because what it's doing is working through different scenarios to reach that answer. It is reasoning to some extent. It's been trained to do this through reinforcement learning. So it takes a bit of time to come to the answer. It's also not multimodal, which means it can't deal with things like audio inputs and visual inputs. But they say, they're working on this. That's a longer-term goal. They're also, by the way, working on GPT-5, so the next iteration. Both of those things in parallel and complementary is what the OpenAI team say on a week when, of course, they're looking to raise $6.5 billion raised and valued at around $150 billion. Maybe this will give investors more pause for thought around that question, or at least give them more of a catalyst to potentially fund this business.
Yeah, I got to be honest. I'm imagining Manus like with a roaring kitty set up, like a gamer chair, screens everywhere, tie around the head. In the meantime, Tom.
Roaring kitty. Oh no.
That's literally what Manus looks like on the weekend. Okay, anyway, Tom, we'll save him. We'll move on. Oracle up pretty decisively pre-market, some 6%. A very optimistic forecast. What was behind that?
They've been hinting at this. Analysts have been waiting. They had expected an upgrade to the fiscal 2026 forecast from Oracle, but what they weren't necessarily expecting was an upgrade to the 2029 fiscal forecast. $104 billion in revenues for that period is what is now being forecast by a company that has really benefited from their cloud software, their database software that really aligns with generative AI and the workloads, the heavy lift, basically, that workload requires. Their software has performed well on that front, and they're seeing that demand from their customers, who include, by the way, Elon Musk's xAI. That's a company they tout. So they upgraded the forecast for 2026 as well, $66 billion, upgraded for 2029, $104 billion. Analysts saying that this shows that, at least for this company, Oracle, those generative AI tailwinds are still there. Year to date, the stock is up around 53%, but as you say, pre-market looking higher again.
Tom, thank you so much. Bloomberg Daybreak anchor Tom McKenzie. As I'm spying on Manus's computer with a picture of Keith Gill, are you getting your outfit ready for the weekend?
I don't know whether I want a red headband. You know, I mean, is this your perception of me over the weekend?
Yeah, the gamer chair, all of that, just like hunkered in, screens everywhere, coding away.
I mean, this she's putting out falsehoods. There you go. The bottom left. So this is me. Actually, I have friends that are meme traders, and they follow everything with this guy. No, I'm not wearing
the long hair.
No, just like barely have any hair to talk about. So I don't think we need to worry about the long tresses, the locks there. No, that's definitely not me. GameStop Corporation. There you go.
Okay, well, that's Manus's weekend plans. But before that, we're going to set you up for the whole
live
week.
On Instagram for you. With my headband.
Tune in to Manus's Instagram Weekend This Live. He'll take you through his latest coding project. Get you set up for your trading day on this Friday. Coming up, we're going to have the University of Michigan consumer sentiment data that comes out at September at 10 a.m. Then former President Trump will have a press conference that occurs at noon. President Biden then hosts UK Prime Minister Keir Starmer at the White House. On the agenda, Ukraine, Gaza, and the Red Sea. Manus, what do you got for our stocks this morning?
Danny, top end and the bottom end of this market are moving. You got Mag 7 on the up, and it's tech in focus. Boeing is the drag here. We know that we're actively in this strike. What is it that management have got to put on the table to bring them over the line? 25% pay rise was put down. You've got Adobe down 8.28%. Again, delivering an outlook that failed to quell investor impatience, especially around the AI tools. And then Oracle, as I say, very, very strong innings for them. Annual revenue will rise to $104 billion. That's by 2029. And an optimistic view on the growth prospects, of course, in, you got it, the cloud business.
And meanwhile, Manus, it is a market that's in rally mode for equities. Meanwhile, bond yields fall by 6 basis points, just nearly on the front end, as that debate of 50 versus 25 comes alive yet again.
Yes, dreams and hopes live eternal. It's been called Nikki Leaks. Of course, it's the Journal story. But don't forget, Bill Dudley said he'd be calling for 50 as well. Surveillance is up next.